Hey, it's Carolyn Grimm with Accounting How To. I am here today to talk about double entry accounting. And of course, we can't do that without our emotional support dinosaur, Terrance, who has now started a cupcake business because, of course, he has. So let's dig in. So, the first thing that we need to understand about accounting is that it's all about tracking transactions. So, every time something happens in a business, it's a transaction. We buy something, we sell something. And whenever there is a transaction, it means that something within the business records has changed. Something's increased or decreased. So with accounting, our job is to track each one of those transactions so that we know what's going on with the business. And every transaction has at least two parts. That's the double entry part. Each one of those transactions is going to impact our accounting equation. Assets equal liabilities plus equity. So every single transaction is going to fit into that equation, which brings us back to Terrance and his cupcake business. So Terrance likes to bake. He's really into it. He's quite a good baker. And he decides that he wants to start a business selling his cupcakes to his friends. Now, before he can sell cupcakes, he has to make cupcakes. And before he can make those cupcakes, he's got to buy some ingredients. So he needs some flour and sugar. So let's say Terrance buys some ingredients. Well, how is he going to pay for those ingredients? Is he going to pay cash now, or is he going to pay cash later, accounts payable? So how does this transaction fit within our accounting equation? So he's buying something. So that's either going to be an asset, like he's buying a car, or it's going to be an expense, like he's buying electricity to run his ovens, or in this case, he's buying ingredients. And we're going to call this, to keep it simple, we're going to call that supplies expense. So that's one part. The other part of this is he paying cash now, or is he going to pay it later? So let's look at what happens with the accounting equation if he pays cash now. So if he pays cash, cash is an asset, and we're going to have less of it once he pays for those supplies. So cash, the asset, is going to decrease. Now, we said every transaction impacts two things. One is how it's being paid for. The other one is what he's getting for his money. So we said he's getting ingredients, and we're going to call those supplies expense. Now, this is the part where if you understand the accounting equation and the types of accounts, that would be super helpful, but let's walk through it. So equity is the value of the owner's investment in that business. And things that will increase the value of equity are if he has money that he's put into the business, or if the business has revenue. Now, what decreases equity is if Terrance takes money back out of his business, a dividend, or if he has expenses. So expenses decrease equity. So in our accounting equation now, we have our supplies expense, which is decreasing equity, and he's paying cash, so that's decreasing cash. So our accounting equation is in balance. So we've decreased our assets, we've decreased our equity. But how does it change if he's going to pay for that later? He says, I will pay you next week for some sugar today. He's still getting those ingredients, so he still has supplies expense. That doesn't change. So we are going to reduce the equity by the amount of what he's spending on those supplies. And instead of decreasing our asset called cash, we're going to be increasing our liability. So now both parts of that transaction are on the right-hand side, the credit side of that accounting equation. So we are decreasing equity and we are increasing a liability. He owes this money, he's got to pay it back later. Now, when he goes to pay that amount, that accounts payable liability, what's going to happen is our cash, the asset, is going to decrease and that liability is going to decrease. But Terrance isn't in the business of just spending money. He also wants to make money. So he's going to be selling his cupcakes to his customers. Now, we said that equity increases when you have revenue. So let's talk about what happens in a transaction where he sells something. There's two parts to that. There is what he's selling it to his customer for, that's our revenue. And then how the customer pays us is going to be the other part of the transaction. Is the customer paying cash or are we going to receive that cash later? Accounts receivable. So if we are receiving cash right now, we already said revenue is going to increase. That's on that equity side of things. And our cash is going to increase. So cash goes up, revenue goes up. Now, how does it change if the customer is going to pay us later? We're going to receive that money later. We're going to keep track of that in an asset account called accounts receivable because we're going to receive that later. So we're increasing an asset account called accounts receivable, and we are increasing our equity account because of the revenue. Revenue increases equity. Now, when the customer pays us, they no longer owe us that money, right? We're going to get cash. So our cash is going to increase. That's an asset account. But right now that transaction is sitting in accounts receivable, waiting for us to get paid. So now we've gotten paid, we need to decrease that accounts receivable. So cash is going up, accounts receivable is going down. That's all happening on the asset side of the accounting equation. Now let's say that Terrance decides that he needs to buy a company car. So what is Terrance going to get? He's going to get an asset that we're going to call vehicles. So on the asset side, we're going to increase that vehicles account, that asset account, by whatever the cost of that car is. So let's say the value of the car, what he's going to ultimately pay for it, is $40,000. So he is increasing his assets by $40,000. And then the difference now is going to be, how is he paying for that? Is he paying for it with cash? So if he's paying $40,000 in cash, his vehicle asset is going up and his cash asset is going down by $40,000. So again, we're all on that left side, the asset side, the debit side of the accounting equation. But what if Terrance wants to take out a bank loan, a car loan, to buy that car? So he's still getting an asset that's worth $40,000. So that vehicle asset account is increasing. The difference is he's not paying cash. So we've got to go to the other side of that transaction. So he's going to take out a $40,000 loan. So now his liabilities are increasing by $40,000. So we've got an asset increase by $40,000. We've got a liability increase by $40,000. But not all accounting transactions have to have just two parts. We can have more than two parts if we need to. Minimum two, maximum whatever you need it to be. So in this case, Terrance will buy the car, that $40,000 increase to his asset account called vehicles, but he's going to split the way he's going to pay for it. He's going to pay for that partly with cash. So his cash is going to drop some, and then the other part of that is going to be a bank loan. So his liabilities are going to increase by $35,000. His vehicle asset is going to increase by $40,000, and then his cash asset is going to decrease by $5,000. So we got $35,000 on one side, $35,000 on the other side. We're still in balance. And what the difference in those three transactions was, he's still getting the vehicle worth $40,000. He's still getting that asset. The difference is in how he pays for it. So that loan amount will decrease over time as he pays those monthly payments. So the accounting equation for every single transaction always needs to be in balance. The assets have to equal the liabilities plus the equity. If you need a refresher about the accounting equation, I've dropped that link in the description. We got a whole video on that. Or if you really need to get clear on the foundations of accounting, for my accounting students, that's the first 4 chapters of your textbook. It's going to go through all of those basic things that you need to understand before you can understand all the rest of it. So I hope that helped. Terrance and I are going to go split a cupcake. Apparently Terrance is going to eat the cupcake himself, and I will see you in the next video.